The stock market is inches away from record new highs. Wall Street is celebrating, but the average American is drowning in credit card debt, can't afford rent, can't afford groceries, and feel worse off than they were last year. So why are these stocks going up while most people are just struggling to get by? Hi, my name is Adrian. I graduated with a degree in economics and I've been in the markets for around 7 years now. And I'm trying to make finance, investing, and business more accessible and simple to understand. So today, I'm going to be explaining why stocks are up and most people are struggling. I'll explain it from both an economics point of view and a Wall Street investor's lens. So by the end of this video, you'll be able to understand why the market is surging, but also what it means for your money. Let's just dive right into it. Here is the disconnect. The Dow just gained 400 points. The S&P 500 and NASDAQ are both within inches of their all-time highs. But let's look at the other side of things. US credit card debt has just hit a record $1.3 trillion. 60% of Americans are saying they are living paycheck to paycheck, and real wages are barely moving. So why are these two realities not lining up? First, we need to understand this. The stock market does not reflect the economy. It reflects companies, not people. And who are the people that own these companies? The top 10% of Americans. They own over 80% of all stocks, while the following 80% own 8% of the stock market. Second, the Fed plays a massive role. During downturns, it cuts rates, adds liquidity, and buys bond. This props up financial assets, making stocks rise faster than wages are. Meanwhile, real economic recovery lags. Small business takes longer to bounce back, wages don't keep up with inflation, and housing and food care prices remain elevated because inflation is sticky. The bottom line is Wall Street runs on asset prices. Main Street, us normal people, run on paychecks, and those two have not been able to keep pace for decades. Now let's look at things through the eyes of an investor. Wall Street isn't ignoring this pain, but it's focusing primarily on profitability, expectations, and policy. So let's see what's driving these stock prices higher. Mega cap tech earning stocks. Nvidia, Apple, Microsoft, all these companies are blowing out quarterly reports, and this is primarily due to huge innovations and investment into AI. So we're seeing huge investment into this, and we're seeing a lot of layoffs for people. So investments in AI is creating more profitability for these businesses, but hurting people because people are being laid off, no longer have wages, and can no longer consume. Another aspect of this is that traders believe that the Fed may cut rates as early as this year or early 2026. But here's the kicker to this. This rally is completely narrow. The so-called Magnificent Seven are lifting the entire index while most other stocks are lagging. So therefore, the stock market is being carried by these 7 stocks. So a takeaway from this is that yes, stocks are up. If tech cracks, the whole market will end up coming down. So your takeaway from this as an investor would be, yes, the stock market is rallying, but this rally is extremely tech heavy. And if tech cracks, the whole market will come down. So you as an investor person, what's going to happen next? So what happens now is that there are 2 key risks. One, if inflation begins to flare back up, the Fed rates will plan to stay high. So as an investor, as a person who's looking out for themselves to protect their 401k, their investments, here's what's going to happen next. I'm going to explain to you the risk and outlook moving forward. So what's going to happen now? There are 2 key risks. If inflation flares back up, the Fed is going to have to keep the interest rates higher for longer. If tech earnings disappoint, this narrow rally will unravel very quickly. On the flip side, if the Fed market signals cuts and the broader economy holds, the market could run even higher. So for investors, this isn't the time to blindly chase gains. Diversify, take profits, and watch the Fed commentary like he hawks. So to recap, the stock market is nearing record highs because of tech earnings and Fed optimism. The average American, however, is feeling squeezed because wages haven't kept up, inflation hasn't fully cooled, and the wealth is extremely concentrated. It's a tale of 2 economies, Main Street versus Wall Street.